Let's go to Caroline Woods joining us from New York with a look at some earnings for us, particularly Texas Instruments, which, as we talked about yesterday, Caroline, I was going to be a lot more interested in this move if it were higher rather than lower, because Texas has been marked by underperformance to its category. So the fact that it's trying to rally is pretty encouraging.
Yeah, and trying to rally despite the fact that guidance fell short of analysts' expectations as well. So shares up about almost 3.5% right now. It was a beat on both the top and bottom line. Adjusted EPS of $1.47, topped analysts' expectations of $1.36. Revenue fell 8% from the year-ago period, coming in at $4.15 billion. The expectation was for $4.11 billion. It was up 9% from the previous quarter, so a sequential improvement. They noted particular weakness in the industrial segment that saw sequential declines down single digits as customers continued to reduce inventory levels. But they did say all other end markets grew. The automotive market increased upper single digits, primarily due to strength in China. Personal electronics grew by about 30%. Enterprise systems was up about 20%. And then communication equipment was up 25% as the cyclical recovery continued in those three markets. But I will say on the earnings call, they were talking about kind of the bottom in terms of the current chip downturn, and they said they haven't seen it yet. The CEO said, we are more than 30% down versus the peak. I don't think we have a lot left. I think the inventory correction is still ongoing, but I do expect that to start to recover. I cannot predict a quarter because usually when we see it, we call it. I just say we haven't seen it yet, and it's been quite persistent. That's on the industrial side. So in terms of that outlook that I said fell short of analysts' expectations, for the fourth quarter calling for between $3.7 and $4 billion in revenue. Wall Street was looking for a little bit closer to $4.1 billion. The expectation was for around $4.06 billion. And then for fourth quarter earnings per share, the calls are for $1.07 to $1.29. Wall Street was looking for $1.34, but shares are up regardless, up almost 4% right now. Keep in mind they were down about 6% this month heading into the report, so maybe some of disappointment in terms of the guidance was already built in at these levels. In terms of the analyst reaction, pretty mixed. If you take a look, Evercore maintained an outperform rating, raised its price target to 298. Morgan Stanley maintained an underweight rating, raised its price target to 167. And then Baird stuck with a neutral rating, lowered its price target to 175. So it just kind of goes to show analysts pretty mixed on this name, but good day for Texas Instruments after this earnings beat, guidance miss.
Okay. Pretty nice little pop and a note of confidence in the market's tone here for sure, given how weak this trade has been and given that the numbers weren't particularly great. The fact that it's getting a pass on a lot of different elements here is pretty impressive. I'm kind of surprised to some extent because some of the other chip makers that are a little bit more cyclical in nature, like Lam Research and the parts suppliers, have been pretty weak. But I guess given the long-term kind of drag that Texas has had since the spring, I guess perhaps it was due a little bit here to kind of wake up. I don't know. I mean, it's pretty interesting. I guess the commentary really resonated with the street here. So that might give us some hope that you don't need the super AI trade to like keep it together. If you can get Texas Instruments holding in. What about Seagate? I mean, kind of similar in that they don't often get listed as like the main disruptor in the AI trade, but you're going to need some form of memory in a lot of these data centers. This one actually had been doing a little bit better though, so the sell-off versus the rally in Texas, maybe this is just kind of about recent performance resetting a little bit.
Yeah, because the data storage company actually beat on both the top and bottom line, and guidance was in line. But if you take a look at what the stock's doing right now, it's down about more than 7% right now following these results. So this is a name that Seagate's up 22% now year to date, up to 53% over the past 1 year. So performing a bit better than Texas Instruments, as you said. So investors not giving it a pass for, inline guidance, if you will. CEO Dave Mosley said Seagate is off to an outstanding start to the fiscal year, highlighted by gross margin expanding to the highest level in more than a decade. Adjusted EPS came in at $1.58. That was 10 cents higher than what Wall Street was looking for. Revenue, meanwhile, rose 18% to $2.17 billion. The expectation was for $2.12 billion. For the outlook for Q2, Seagate guided for $2.3 billion in revenue, plus or minus 150 million. Wall Street that's basically in line with what Wall Street was looking for. Sees a adjusted Q2 EPS of $1.85 plus or minus 20 cents. Analysts were looking for $1.48, so that surprised to the upside there. Also boosted their dividend by 3% to 72 cents per share. In terms of analyst reaction, that's on the whole positive. Several price target hikes, but did also catch a downgrade from benchmark, downgraded shares to hold from buy. But if you take a look at some of those price target hikes, Rosenblatt raised to 140 with a buy rating, Evercore adjusted to 132. That was also a hike. Mizuho to 130, Citi at 130, Goldman bumped to 112. They're in the neutral camp though. So shares down about 7% right now, trading around 104.63. So all of those price targets higher than where it's currently trading, but did get a downgrade.
Okay. That's pretty big.
New York Liberty team, feel free to walk by.
Pretty big.
There's the New York Liberty
drop.
Players walking past.
I love it. What are they? Do they win something?
You what?
Are they celebrating? All right.
They're celebrating. Yeah, they rang the opening bell.
Ah, okay, nice. WNBA
you can always tell when there's
right?
athletes here because you have to look up to see them.
All right, I'm woefully behind on the news there. Okay, all right, producer got in my ear. Thanks for that, bailing me out there. All right, let's talk some Enphase. We teased it a little bit earlier, Caroline. What's going on?
Sorry, Oliver, you cut out, but are you looking for Enphase?
Yeah, tell me about it.
Oh, yeah, sure. Enphase Energy shares down 14%. Not a huge surprise here because this was a miss on both the top and bottom line. The company is facing weaker demand in Europe. Adjusted EPS of 65 cents, missed what Wall Street was looking for, around 78 cents. Revenue did rise 26% to 380.9 million, but Wall Street was looking for 391 million. U.S. revenue rose 43% sequentially, thanks to higher shipments to distributors. Inventory returned to normal, but revenue in Europe dropped 15% compared to the previous quarter, the result of a further softening in European demand. They did ship 1.7 million microinverters in the quarter. In terms of guidance, disappointed on that front too. Guided for Q4 revenue to be in a range of $360 to $400 million. The consensus was for more like $434. In terms of analyst reactions, several price target cuts on the street. Guggenheim did downgrade to sell as well with a $73 price target. So even with this 14% decline right now, it's trading above that level, just around $80 a share. Goldman Sachs cut to 145 from 170. Mizuho down to 130. Mizuho down to 123. Raymond James down to 130. Piper Sandler down to 85. So several price target cuts across the board. Enphase had already been, pretty sluggish. So, in terms of year-to-date performance, but adding to those losses today, now down about 40% year-to-date.
Wow. Seems like oversupply and not enough demand. It was just very, very simply kind of the solar situation with particular lack of demand or disappointment coming from European markets too, as we talked about earlier, in addition to here. So just an ugly chart, bottom line, through and through. All right, appreciate it. Thanks, Caroline Woods.